In this chapter, we are going to be talking about monetary policy. So this is chapter 35. We're talking about monetary policy. And monetary policy is what the Fed uses to change aggregate demand. All right, so in a little while, maybe not in this video, probably in the next one, we're actually going to use our aggregate supply, aggregate demand model to look at why they want to do this, or at least graphically. The reason why is because they want to affect the macroeconomy. We'll get a little bit more specific in the next video. But the way that the Fed affects aggregate demand, we've already talked about. Right? In the last chapter, we talked about the tools of the Fed. Right? And we have two, but I'm going to include one, an extra one that we did mention but was not on its own in the last chapter. All right, so we have open market operations, and then this is the one that didn't have its own little subheader. It was under the open market operations, but the federal funds rate. And finally, interest paid on total reserves. All right, so those are the main tools of the Fed. This is the mechanism through which they are going to try to influence aggregate demand. All right, so just really quickly running through these, just a recap. Open market operations, this is when the government is, or when the Fed is buying and selling government bonds. The federal funds rate, this is the overnight rate for banks that are borrowing from one another overnight. And interest paid on total reserves, kind of what it is, right? Anyone that has an account with the Fed, right, just like other bank accounts, right, they are drawing interest, all right, although that is somewhat recent. All right, we're going to make a distinction between two types of policy. And this is going to apply to chapter 37, I think, when we were talking about fiscal policy as well, right? So expansionary policy is policy that increases, or at least is intended to increase, aggregate demand, right? So if the Fed uses any of those three tools to try to increase the money supply, increase aggregate demand, right, then that is expansionary policy. Right? The other side of that coin is contractionary policy. Right? You probably figure out what that means, but it is it decreases, right? It's policy that is intended to decrease aggregate demand, right? So expansionary, kind of just expansionary, it's getting bigger, increases, it's expanding, right? Contractionary, it's shrinking or it's decreasing, right? Makes sense why they're named what they are. So looking at these, all right, so for open market operations, the expansionary is when the government is, or when the Fed is buying bonds. Right? So when the Fed buys bonds, they're putting more money out into the economy, increasing the money supply, right? So that is expansionary, right? Contractionary policy using open market operations would be the opposite, all right? So this would be when the Fed sells bonds. All right, then with the federal funds rate. So if we remember from the last chapter, and hopefully we do, as I previously stated, this is the overnight rate at which banks will loan to each other. And we mentioned that this is used more as a signal than an actual tool of policy, right? Because it is the overnight rate that's very short term, that's not going to really be doing a whole lot of changing to aggregate demand. But what it does do is signals to other people kind of outside of the Fed their intentions, right? So if the Fed is planning on doing some expansionary fiscal policy, or, well, the Fed won't do expansionary fiscal policy, but if they want to do expansionary monetary policy, then they might decrease that rate. All right, so why would that signal that they want to do expansionary policy? All right, well, if you decrease the rate, decrease the interest rate on a loan, it encourages or incentivizes people to take out more loans, right? Because they are now cheaper, right? So it's encouraging kind of these banks to take out these loans, and again used more as a signal. And of course, the flip side of that, if the Fed is going to be pursuing contractionary policy, right, they would increase that federal funds rate, right, making those overnight loans more expensive, and making it so that banks are less likely to use those. And last but not least, interest paid on reserves for our expansionary. We would expect a decrease in the interest rate paid on reserves. All right, so if the Fed decreases the interest rate that banks and other financial institutions are earning on the reserves that the Fed holds, then they are more likely to withdraw some of, convert some of those electronic claims into currency, or, however they're going to switch it over to themselves, right? So they're going to withdraw it from the Fed, right? And then they're likely going to loan that money out or do something else with that money so that it gets into the economy, all right? So we're expanding the money supply because this money is no longer just sitting at the Fed. It's now kind of out in the market. All right, and for contractionary policy, the Fed would increase their rate on interest, right, or the interest rate that they pay, right? That makes holding money with the Fed more lucrative, and therefore more likely for kind of these banks and financial institutions to increase the amount of money that they hold there, therefore taking money out of the economy, right? So with this rate increase, a bank might say, hey, well, let's take this amount of money. We would have used it to give small business loans, home loans, car loans, whatever it is, but now holding it at the Fed, right, or putting it into our account with the Fed is going to get us a more desirable return, right, in whatever way that happens, right? And so that money that could have been in the economy going to those different types of loans now is just sitting in the Fed. So we have a decrease in the money supply. All right. So for this video, I really just wanted to introduce kind of the concept of monetary policy. That monetary policy is the policies about really money, right? So how much of it is being created and how much of it is kind of circulating out in the economy, right? So this is what the Fed uses to influence that aggregate demand curve, and therefore kind of influence the macro economy, right? Also just introducing that idea of expansionary versus contractionary monetary policy and looking at how each of these tools would be used for expansionary or contractionary policy, right? But we've done that, so that's it for this video. In the next video, we are going to look at the best case for monetary policy, so when it works, or when it's likely to work the best, and that's when we'll actually get into some of the graphing, but I will see you in the next video.